strike selection and moneyness. These are all things that go into the value of the option contract. Options pricing has two components. We've got intrinsic value, which is the inherent value of the option, and extrinsic value, which is everything outside of that. One of the ways I like to explain it, coming from Chicago, I like to say that, let's say you had a $10 bill. Inherently, that $10 bill is worth $10. What if we got Michael Jordan to sign that $10 bill? Again, being from Chicago, he's a Chicago icon. An autograph, Michael Jordan's autograph on that $10 bill is going to be worth something more than $10. So the bill itself, that's going to be the intrinsic value. It's inherently worth $10. Michael Jordan's signature, that's going to be the extrinsic. If I could sell that $10 bill for, and hypothetically, I don't even know what Michael Jordan's signature is worth, but let's say it's worth $10. If I could sell that $10 bill for $20, I've got $10 of intrinsic value and $10 of extrinsic value, right? Is that clear? The intrinsic value is going to be the difference between the stock price and my strike price of my option. And let's say we're talking calls. If I had a $50 call, it gives me the right to buy those shares at $50 per share. If stock is trading 60, now my right is inherently, intrinsically worth $10. So that's intrinsic value, difference between my stock price and my strike price. Extrinsic value is going to be everything else. And by everything else, I mean days until expiration. I mean the implied volatility level, whether or not there's any dividends attached to the option, interest rates, right? Those are all going to be pricing inputs extraneous of the stock price and the strike price, but those extraneous inputs still impact and create the value in that option. And we call it time value because one of the ways I like to explain it is that you are purchasing time for something to happen. If I'm buying a $50 call, and let's say stock is $45 in the market, I'm buying a $50 call. It's what we call out of the money because there is no inherent value to it. There is no intrinsic value. Then in order for me to profit, I need that stock price to go above $50. In that time that it takes for that to happen, or the possibility, the opportunity for that to happen, that's what I'm actually paying for. That's all of that time value. That extra money that I'm plunking down outside of intrinsic value is the extra time that I'm purchasing for my forecast to come to fruition. And hopefully it will. Because at expiration, options are only worth their intrinsic value. They have no extrinsic value whatsoever. All time value disappears at expiration. In the money options have intrinsic value only. They may also have that time value that we were talking about, but at the money and out of the money options only have that extrinsic value. There is no intrinsic or inherent value to them. So when we look at call options, the difference between in the money, at the money, and out of the money, the chart on the right, and again, if you want copies of these slides, drop us an email, options@theocc.com, and we'll be happy to get you a copy of the entire deck. But call options, it's a little easier to understand pretty much anytime you're talking about options. Call options are maybe a little bit more intuitive for people, but when we talk about in the money for a call option, it means that our strike price is lower than our stock price. At the money, whether it's going to be a call or put, that is where our strike price equals our stock price, or at least is fairly close to it. Out of the money is where our strike price is above our stock price. That's where we really need for things to happen to our option in order to realize some profits. We need for that stock price to move, or any of those pricing inputs that we had talked about, implied volatility specifically. We need those to move or cooperate with us in order for us to generate profits on our trade. Put options are going to be the opposite. The put option, when we're buying it, it gives us the right to sell stock at that strike price. So for my put option to have inherent or intrinsic value, the strike price has to be above where the stock is trading. If I've got a right to sell that stock at $75 because I bought that put, in order for that to have any inherent or intrinsic value, that stock price needs to be below 75, right? So that's where it becomes in the money, where my strike price is above my stock price. Out of the money is going to be where my strike price is below the stock price. One key point that I want to talk about is in the money, at the money, out of the money has nothing to do with profit. In the money, the definition is that the option has at least 1 cent worth of value. So if I had a $50 call option and stock closes at $50 and a penny, my option is technically in the money because it has inherent value. It's got 1 cent worth of intrinsic value. Now, if I paid $1 for that option, even though my call option is finishing in the money, I'm still going to lose 99 cents on the trade, right? I paid $1 for it and it's worth a penny. I'm going to lose 99 cents. So moneyness does not equal profit, something that I want to make sure that everybody understands. In the money options are more expensive than at the money or out of the money, which makes sense, right? If I've got the right to buy stock at 45 and it's trading 50, that option is going to be worth $5 at least, versus my right to buy the stock at $55 because I've got an out of the money option and stock is trading 50, which is going to have greater value. Obviously, the in the money because it's got that immediate intrinsic inherent value. In the money options also offer a more favorable break-even point, which we'll look at in just a moment. And they also have that greater likelihood of the stock finishing in the money. If it's in the money now, there's a greater likelihood of it remaining in the money than than an option that is currently out of the money. Stock is trading $50. It's likely that my $45 call is going to remain in the money. There's a higher probability of that versus my $55 call, which is out of the money. I need that stock to rally at least 10% in order for that out of the money call to have any intrinsic value. Whereas my in the money call, it's already in the money. Stock can drop 10% and I'm still in the money, just barely, but stock can drop roughly 10%. So the movement of that stock with an in the money option is not necessarily as important as it is for an at the money or an out of the money. Out of the money strikes, therefore, are less expensive. They also have less favorable break-even points, and they have a lower likelihood of finishing at expiration with any intrinsic value. And let's break this down. This might put things in a little bit more clear of a perspective. Here's a scenario. We've got a stock trading $75, 45 days to expiration, 30% implied volatility, right? So these are some of the pricing inputs. We know what the stock price is. We know how long of a duration or days till expiration. DTE is a phrase I'm sure most of you are familiar with. So we know the stock price. We know our DTE. We've got our implied volatility. The only thing that we're really missing in order to price this option is the strike price and then dividends and interest rates, if any. And dividends and interest rates, we usually kind of leave those out of the equation when we're educating because they're not as much of a factor normally. But let's look at a difference in strike prices here. So stock is trading $75. The at the money, right, the 75 strike call, you can see here is trading for $3.15. Let's see if this works here. So $3.15. I'm not sure if anyone can see that. The first column, $75 call, $3.15. Our break-even point is $78.15. That means that we need that stock to go beyond, at expiration, we need that stock to go beyond $78.15 in order for us to profit. So the break-even calculation with a long call is simply your strike price plus the premium that you pay. So the at-the-money call, $75 strike, $3.15 premium. Our break-even is $78.15. That $3.15, when you buy options, the most that you can lose is what you're putting into it. So that $3.15, not only is that the premium that we're paying, but that's also going to be our maximum loss potential. We cannot lose more than that. And as each option typically controls an interest of 100 shares of stock, we've got a standard multiplier of 100. So $315 becomes $315. We cannot lose more than $315 if we buy that $75 strike price. All right? As we're moving up and down the option chain, let's look at out of the money. Let's go to the $85 strike. So that's going to be at the bottom left of your screen there. That's trading for just under half a buck, so 48 cents. That's going to be if we bought that, that's going to be our maximum loss, 48 cents per option contract or $48, right? So with the at the money, we can lose 315. The out of the money, we can lose 48. Now, the trade-off seems kind of simple, right? Which one would you rather have? I'd rather have $48 at risk than $315 at risk. That kind of makes sense. But that's only one side of the equation. The other side is, let's look at our break-even point. With our at the money, our break-even point is $78.15. Let's just call it $78 even. We need stock to move beyond that point in order to profit. With our out of the money 85 strike call, we need stock to go beyond roughly $85.50. So we need that stock to make a significantly higher move by going with an out of the money option than we do with an at the money. So sure, we may be risking less of our dollars, but we also have a lower probability of turning a profit on this. You know, which is more profitable? The stock going to 78, not profitable. Which is more probable? The stock going from 75 to 78 and change, or from 75 to 85 and change. Obviously, that lower strike, that lower break-even point is going to be more easily attained, and therefore you're going to have a higher probability of hopefully turning a potential profit. So the further out of the money we go, the less premium we're collecting, the less risk that we have, but also the less likelihood or the lower probability that that contract is going to turn profitable. Go down to in the money. This is where things get interesting. $65 strike, right? So now we're $10 in the money. The $85 strike was $10 out of the money. So we're kind of equidistant. The $65 strike is trading a little over $10. So we've got over $1,000 of risk if we buy that option and things don't turn out the way that we want. Got over $1,000 worth of risk. But look at that break-even point, $75.30. Stock is trading 75 in the market. So we really don't need a lot of movement in that stock price in order to turn a profit on that trade. We only need it to go up, 30 cents and change, something like that, in order to start profiting on this trade. Whereas with the out of the money, we need that stock to rally more than $10. So it's a significant increase. So, in the money, at the money, out of the money, they all have their benefits. They all have their, there are pros and cons to everything. And just like with options trading, there's always going to be a balance, risk versus reward. But, these are things that you'll keep in mind when choosing a strike. You'll want to look at what that break-even point is going to be, what that risk situation is going to look like for me. Delta is another thing that some people concern themselves with. Delta is going to be the options sensitivity to those changes in the stock price. Some people equate delta to the speed of the option, how quickly that option value is going to move as the stock price moves. So these are all things that when you're buying options, you're going to want to ask yourself, again, what's my forecast? Where do I think the market is going to go? And how long is it going to take to get there? What is my objective? Am I looking for leverage? Am I looking for speculation? And then what am I looking for in terms of risk, reward, break-even points, et cetera? That's all going to come from those strike prices. So these are all questions that you're going to be asking yourself, and hopefully providing some fairly accurate answers before purchasing options. All right. Duration, DTE, days to expiration. When I started in the business back in 97, there was basically monthly options. All right. So they expired the third Friday of the month. That was it. There were also, maybe end of quarter, end of year options, but really monthly options was the biggest thing. And expiration week was the biggest event of the month. As a broker, that's when that week is when I did the most business for the month. I, typically did about half of my business for the month in just that week. And expiration was actually so important that was one of the weeks that you were absolutely forbidden to take vacation time. I remember I had to schedule my wedding around expiration week. But with the exchanges, once they went public and for profit, and they started being more responsive to customer demand, right? Just like any other business, they respond to demand. So the exchanges responded to the demand of the customer, saying, we want more flexibility. We want to be able to tailor our trading a little closer to specific events, an earnings release, a drug trial result, a federal election, right? We wanted to have more flexibility with our contracts in terms of longevity outside of, once a month. So they created weeklies. They also created something called LEAPs, which are long-term equity anticipation securities. Really, LEAPs are just long-term options. They behave like any other option pretty much. But now we've got all of these different expirations to choose from. And again, we want to be cognizant of that time is money, because the further we go out in time, the more we're going to be paying for it. So if we had a $50 strike, the LEAPS option, going out a year or more, is going to have the largest premium attached to it. The monthly option would be a little bit less, right? Let's say we're going 30 days or 6 months. That's going to be even lower. And then weekly options, lower yet. Zero DTE, one of the buzzwords that's in the trading zeitgeist right now. Obviously, those are going to be the cheapest options because they've got the shortest time frame. But we want to remember, it's not only the direction that we're picking, we're also picking the magnitude of that move, right? It's not really enough as an options investor, unless you're a speculator, to simply say, I think the stock is going to go up. Yeah, that could work. That might work out terrific for you. It would be better, or a more accurate forecast might be, I think the stock is going to go up 5%, or I think the stock's going to go up 10%, and maybe it's going to take 3 months to get there. The more you can fine-tune your forecast, your objective, et cetera, the more you're able to zero in on what specific strike you want, how much premium you're willing to pay, how much risk you're willing to take out, because the last thing that we want to do is buy more time than necessary. I don't want to buy 6 months worth of option premium for an event that I'm trading around that's going to happen in 3 months. So we're never going to want to buy more time than there actually is. Theta, or time decay, I was mentioning days till expiration as one of those pricing factors. Theta and time decay are concepts that tells us that with each passing day, I mentioned an option is a decaying asset. Each passing day, that option is going to be worth less money. Now, you can see by the graph here, when we start out at the genesis of that option contract, and let's take a LEAPS option, right? Let's say we're looking at an option expiring a year and a half down the road. Well, with each passing day, from a year and a half out, you're not going to see that much change in the value of your option from a time perspective. Because instead of, a year and a half is, about 550 days, roughly, something like that. Day 550, the option's worth X. Day 549, it's not going to be worth that. There's not going to be that much of a difference one day when you still have so many days to go. But it's when we approach expiration, that's when you really see that time decay accelerate. Time decay is exponential. On expiration, remember, the option is either worth its intrinsic value or it's worthless. It's a binary event. It's either worth something or it's worth nothing. So all of that time value, all of that extrinsic value in the option is going to get sucked out of that contract that last day of trading. So if you've got the last day of trading and the option is still out of the money and it's worth a quarter, at the end of the day, it's going to be worth zero, unless that stock makes the right move to put that out of the money option in the money. So you're going to lose all of that time value at the end of the day. These are things that are working against the option buyer. Time decay is working against you. And each and every day, you're going to lose a little bit of value of that option, which is why it's necessary for those things to happen, like the stock price increasing, assuming we're talking about long call options. That's why we need that stock price to move to offset the guaranteed loss of value that we have with time decay. We need implied volatility levels to increase in order to offset the guaranteed loss of value that we're going to experience with time decay. And those are the reasons that we're purchasing that time value, that extrinsic value in the option. We're buying that time for something to happen because something needs to happen in order for us to profit, all right? And if it doesn't, that's where that time decay is going to erode all of the value of our contract until on expiration, there is nothing left, no value, and we lose whatever premium that we had paid into it. And here are two different examples of how time decay works, both with a lower volatility option and a higher. So Theta, that's going to be the amount of the options premium that decays per day, as I'd mentioned. On the left side of our screen, we've got a typical option $50 at the money call, trading with a 20% implied volatility level. And we're going to juxtapose that with the at the money option with a 40% implied volatility. So with a year out, this at the money call on a $50 strike, with a year out, it's worth about $4, $3.98. And you could see that Theta, it's less than half a penny, right? So that time decay really isn't doing that much for us or against us because we're buyers. When we talk about time decay, the phrase I like to use is that time decay is a friend to option sellers and it's a foe to option buyers, right? Just something to keep in mind. So a year out, this option is worth about $4 at a 20% implied volatility. With 5 days left, so now we fast forward throughout almost the entire year, and assuming that stock price is still $50, assuming the stock hasn't moved, assuming implied volatility is still trading around roughly 20%, and certainly the stock can be moving, implied volatility can be moving all throughout that year, but with this snapshot, we're just assuming that 360 days after we first put on that trade, we're back to where we began. Implied volatility is at the initial level, stock price at the initial level. And look at the value of our option. It went from almost $4 down to below 50 cents. So we lost a significant amount of that option premium because the market didn't do anything, because it didn't cooperate and provide us the changes that we needed to offset that time decay. So whereas Theta, when we first put that trade on, was decaying the option less than half a penny a day, look at 10 days out, right? We got about a week and a half to go. Now it's about 3.5 cents per day that we're losing. 5 days, less than a week before the contract expires, we're losing almost a nickel a day in time decay. So that time decay is going to continue working against us. We need for good things to happen to offset that. When we change the volatility, right, now we've got an even more volatile stock. The market is expecting the future volatility of this stock that we're investing in to be more significant than it had been in the past. Implied volatility increases. Well, a year out, look, our option is trading almost $8. One of the reasons that I like to highlight this is earnings season. A lot of us might look to trade or look at earnings season as an opportunity for potential profit. Other people look at earnings season as an opportunity for tremendous risk, and they stay out of it altogether. I know a lot of option veterans that have been in the business 30 some years, and they swear that they will never invest around earnings season simply due to all of that uncertainty, right? It's an unknown event. And sure, you've got expectations, you know what might happen, but what might happen and what actually happens can be two very, very different things. So earnings season can be a terrific opportunity for potential profits. It also can be a horrible opportunity for prospective losses. Sorry, lost my word there. But the reason I wanted to show you this, to look at these two scenarios is, let's say, and let's look 30 days out. 30 days out, our at-the-money 20% vol call is trading for $1.14. That's the value of it. And that might be the value of that option, kind of throughout the year with 30 days until expiration. But now an earnings event comes in. And now that option that's normally trading $1.14 or so, give or take, is now trading twice that, right? It's now trading for about $2.28. The reason that I'm highlighting this is because, again, it kind of goes back to the timing of your purchase when buying options, that things can be more expensive. It's almost like eggs right now. A couple of years ago, we could get eggs for, a couple bucks a dozen, and now we're paying, 3 times that or more. So it all depends on when you're looking to get into some type of thing. If you're looking to get into an option around earnings season, that increase in demand is going to drive up option prices. Just like, with eggs right now, we're having not only an increase in demand, but it's being paired with a decrease in supply. So that's why we're seeing, the egg Armageddon or the egg apocalypse that we are currently. But the idea is that with earnings season, a lot of people see that as opportunity, and they start expressing that opportunity by buying options. And by doing so, that's going to drive up the option prices. So you can see here, with a higher implied volatility, that option is going to be significantly more expensive. Now, depending on when you get into that trade, you might be getting into it when it's still trading in the dollar range versus getting into it later and maybe more towards that earnings event when it's trading in the $2 range. So timing is certainly critical, something to keep in mind. But again, going back to the not buying more time that you want, once that unknown event becomes known, once those earnings numbers are released, that earnings report is released, there's a chance, and some people say there's a high probability or likelihood that that implied volatility level is going to come back down to its previous levels. And one of the things about implied volatility is that it's positively correlated with the options market. So with the call option or with the put, when you're buying options, if implied volatility increases, and it, kind of the same thing, if you're buying an apple and more people want apples, well, the price of those apples are going to go up, right? It's just kind of, economics 101. So if you're getting into that contract ahead of earnings, typically prices might increase because of that run up in implied volatility. But once the unknown becomes known, then it's expected, or there's certainly a potential for that volatility to come back down and those options becoming cheaper. So if you're buying options and you get in maybe right before that earnings event, and let's say you just arbitrarily, let's say the option costs $3, and you get in the week before earnings are released, maybe not much happens to the stock price or future direction that the company puts out there. But now the unknown is known, and now that $3 option is trading for $2, right? Nothing really happened with the market except implied volatility came back down to its normal levels. So again, just something about timing, not buying more time than you need, because now if you've got the option for another 6 months, you certainly saw a decrease in that value. You've got more time for good things to happen again. Remember, that's why we purchased all that time to begin with. but just something keeping in mind when, looking at certain events, and when you're looking to purchase options, be cognizant of those corporate actions that are on the horizon, because that should certainly factor into your decision.